Welcome in second lecture in risk management course. In this lecture we will discuss banking regulations. In the first section we will discuss the basic issues and dilemmas that inspired in the new regulation waves. In the second section we will discuss capital adequacy, also Basel Accord, Basel I, Basel II. In beginning, regulations. Regulations have several goals. Improving the safety of banking industry. How that? By imposing capital requirement in line with banks' risk. Leveling the competitive playing field of banks. How that? Through setting common benchmark for all players. And promoting sound business and supervisory practices. Regulation have a strong impact on risk management. The regulation framework set up the constraint and guideline that inspire and effect on risk management practices and simulates the development and enhancement the internal risk model and internal risk rates. Regulation imposing capital charge against risk are a strong incentive to improve risk measure and control. Improve risk measure and control for the bank. And set minimum standard of sound practice. Main objective for regulation promoting level playing field without distortion in terms of unfair competitive advantages. Also promoting sound practice contributing to the financial system safety. Why we need regulation? We need regulation when the bank taking the risk is normal behavior of the financial institution, given that risk and expected return are so tightly interrelated. Why? Because of protection of bank depositors that exist. Sometimes adverse conditions are incentive to maximize risk when banks face serious difficulties. By taking additional risk, banks maximize the chances of survival. Capital adequacy. The main pillar of regulation is capital adequacy, as known as capital to risk, is the ratio of bank capitals to its risk. That's line are defined by group regulators meeting in Basel. Hence, name Basel Accord. The Basel Accord is a set of recommendations for regulations in banking industry. The first Basel Accord was 1988. The purpose of Basel was prevent international banking from building business volume without adequate capital backing. And the reason for Basel was create level playing field for internationally active banks. Also, according to Basel Accord, focused on credit risk and set minimum capital standard for the bank. The first accord for the Basel was 1988, but became effective in 1992. New concept in Basel, risk-based capital. Basel was held for incorporating risk into the calculation capital requirement. Cook ratio. Named after Peter Cook, Peter Cook was chairman of Basel Committee. Cook ratio referred to capital divide the risk-weighted assets must be equal or larger than 8%. According to Basel, definition of capital equal core capital plus supplementary capital minus deduction. Basel capital requirements. Capital was set at 8%, was adjusted by loans credit risk weights. A credit risk weight dividends 5 classification: 0%, 10%, 20%, 50%, and 100%. Example for commercial loans were assigned to the 100% risk weight category. To calculate required capital, a bank would multiply the asset in each risk category by category risk, and then multiply the result by 8%. Example, thus 100 commercial loan would be multiplied by 100%, and then by 8%. The resulting in capital requirement will be $8. $100 multiply 8% will equal $8. Now, main definition of capital according to Basel equal core capital supplementary capital minus deduction. Core capital refer to paid up capital and disclosed reserves, while supplementary capital includes general loans and provisions, also undisclosed reserves, assets revaluations reserves, and hybrid instruments. Now, definition of capital: core capital plus supplementary capital minus deductions. Deduction refers to investments in unconsolidated banking and financial subsidiary companies, and investment in capital of other bank and financial institutions also include goodwill. Now, there are classification of risk weights: 0%, 10%, 20%, 50%, and 100%. The zero risk category is comprised of cash and central bank and government debt, and any organization for economic cooperation and development debt, while public sector debt can be replaced in 0%, 10 or 20 or 50 category. That's depending on the debtors, while non-organization economic cooperation and development, public sector debt, and cash in collection comprise the 20 category. The 5% category is mortgage, while the 100 category is represented by private sector debt and non-organization economic cooperation and development bank debt. Maturity over 1 year. Also include real estate and equipments, also capital instruments issued by other banks. Critique of Basel. Basel Accord was criticized for taking too simplistic approach to setting credit risk weights and for ignoring other type of risk depend on classification of risk weights, but ignoring other type of risk. The problem with the risk weights were based on what the parties the accord negotiated rather than the actual risk. Risk weights didn't flow from any particular insolvency propriety standard. Also, the requirement did not explicitly account for operating and other form of risk. That's maybe be important. New approach to risk-based capital. By the late 1990s, across the issue regulatory capital arbitrage led Basel Committee to work on new Basel. The effort focused on using internal rating model and internal risk models. In 1990, committee issued proposal for a new capital adequacy framework to replace 1998 Accord for Basel. Basel II. According to Basel II consists three pillars. Minimum capital requirement for credit risk, market risk, operational risk, expanding the 1998 Accord. This is pillar 1. Supervisory review of an institution capital adequacy and internal assessment process. This is pillar 2. And effective use of market disciplines are level to strengthen disclosure and enhancement save of sound banking practice, pillar 3. Basel II focused on minimum capital requirement, capital divide credit risk, market risk, and operational risk must be equal or larger than 8%. Minimum capital requirement include capital measurement and market risk, also operational risk. For that, pillar 2 trying to achieve if the bank on internal calculation show that they have externally risk. Also, lower risk loans should carry lower risk-based capital charges. Credit risk measurement. A credit risk measurement focused on standard methods using external rating for determining risk weights. Also include internal rating methods. That's referred to bank computes only the probability of default and computes all risk components except effective maturity. Computes all risk components, exclude effective maturity. Also include operational risk measurement. That's referred to basic ratios approach, standard approach, and internal measurement approach. Also, pillar 1 adds new capital components for operational risk. Operational risk governs the risk of loss associated with the system breakdowns. Pillar 2, supervisory review process. Now, supervisory authority responds to evaluate capital adequacy, evaluating how well banks are evaluating their capital adequacy. While Pillar 3 refers to market discipline, the aims enhancement of market discipline through enhancement of disclosure by banks. Implication of Basel II. The practice in Basel II represented several important but the very largest banks will operate under the system that is different on used by another banks. Also, Basel II proposal rely on bank on internal risk estimates to set capital requirement. Despite Basel quantitative basic, much will still depend on judgment of bank formulating their estimates and supervisor in validating the assumption used by bank in their model. This main implication of Basel II. Thank you for your attention. See you in second lecture.